Friday, January 30th, a market that hadn't crashed in 45 years collapsed in hours. This is the precious metals crash and how a single political announcement triggered the worst silver rally since 1980s. Let's rewind. Heading into the final week of January, gold and silver were vertical. Silver surged more than 20% in a single month, 128 ounce, and gold followed, pushing towards 5600. This wasn't long-term investing. This was momentum powered by maximum leverage. And leverage makes markets fragile. Friday morning, 7 a.m., President Trump announces his nominee for Federal Reserve Chair, Kevin Walsh. Market didn't debut resumes. They priced implications, hawkish, higher rates, a stronger dollar, and weaker precious metals. The dollar snapped higher, nearly 1% in hours. That's enormous for currency markets. Concerns over Fed independence spread, profits were taken, momentum flipped, and suddenly leveraged positions were exposed. They came into a mechanical trigger. The CME raised margin requirements effective immediately. If you were long gold or silver, you needed more cash now, and if you couldn't post it, your position were closed for you. The Cascade Effect. The Walsh announcement selling begins, the silver breaks below 100 and then hits 78, $5 trillion liquidated in a day. That's a huge intraday collapse. Don't panic, this was forced selling. Here is how crash feeds themselves. Margin hikes for selling, selling crashes price, crashing prices drain liquidity, and low liquidity forces more selling. A closed loop liquidity death spiral. The close over $5 trillion in leveraged exposure had been liquidated, silver ETFs collapsed, mining stock followed, volatility reached levels not seen since 1980s, and fundamentals never changed. Here is the takeaway: political announcements shift psychology instantly, leverage amplifies volatility into catastrophe, margin calls creates cascade, not price discovery. Risk management isn't option, it's survival. Thank you for watching Quant. See you next time.